Hello, this is Jessica Alfaro, manager at CapPlus Exchange. I'd like to welcome all of you to the first CapPlus Exchange and SME Finance Forum webinar of the year, Credit Scoring and Data Innovation Part 1, Designing and Implementing a Successful System, presented by Nicole Stubbs of First Access. Thank you so much for joining us today. Nicole is the co-founder and CEO of First Access, an award-winning data analytics company pioneering the first instant credit scoring system for the global informal sector. Recently nominated for the Forbes 30 Under 30, Nicole is a thought leader in inclusive finance and winner of a variety of business plan competitions and social innovation fellowships. Nicole has extensive fieldwork experience in financial services in Asia, Africa, and Latin America. Nicole holds a Master of Public Administration and Development Economics from Columbia University's SIPA and an undergraduate degree from Kenyon College. We're very, very pleased to host this jointly with the SME Finance Forum, and I'd like to turn over the session just for a few moments over to Matt Gamser. Matt, I've just taken you off mute, so hopefully you're able to speak, and Matt can share a few words.
Thank you, Jessica. I hope everybody can hear me. This is Matt Gamser. I'm the CEO of the SME Finance Forum, and I just also wanted to welcome you to this first of what is going to be many interesting activities that the CapPlus Exchange team and the SME Finance Forum are going to be putting on together over this year and I hope several years hence. We are entering into a very exciting partnership, and all of your institutions will be hearing lots more about what this will bring in the near future from myself and from Lynn Pickholtz. And what I don't want to do is take away from what's going to be a very, very exciting seminar. I had a chance to meet some people from First Access about 6 months ago, and they're doing incredible work, and I know you're going to really look forward to hearing more from Nicole. So with that, I'm going to sign off and turn it back to Jessica.
Thanks, Matt. And we do have several more upcoming webinars as part of this ongoing series on credit scoring and data innovation. So I encourage you all to attend this. And these are all free of cost for our SBBN members as well as the general SME Finance Forum clients and community. And I also am looking forward to seeing many of you at our upcoming Credit Risk Forum in Goa, India next week. You can access all of our webinar programs and events at the website listed below, and as I mentioned, the video of all the completed webinars are available on that website as well. Please do feel free to send out this webinar calendar to anyone you think who would benefit at your institution, as they're welcome to join as well. And now I'd like to turn it over to our very experienced facilitator, Nicole.
Hi everyone, thank you all for having me. It's exciting to be here. And I'm just going to go ahead and jump in. First Access, as Jessica said, is pioneering the first instant credit scoring system that will work across all emerging markets. And I'm going to talk through expectations, context, and goals for starting to use any sort of credit scoring system, understanding the numbers behind credit scoring and how to compare different metrics for accuracy, and then really what to do with credit scores, because if you're not using them, they're not going to do you any good, and figuring out how to use them requires some planning and some structure. So we're going to go through how to segment your customers with credit scores, then moving to risk-adjusted pricing, which are really, and customer segmentation and risk-adjusted pricing are really the two ways to kind of maximize your benefits from credit scoring. And we'll go through a little bit on strategy and implementation thoughts, different ways of delivering scores and decisions, the First Access methodology, specifically a case study, a little more on First Access, and then there are some very helpful pointers in the appendix on data best practices for collection and organization. So, it's going a little here. Okay. So expectations for credit scoring in informal markets specifically. The bulk of cost savings from credit scoring comes from two sources. the evaluation of customers and credit losses. Implementation of credit scoring is going to require process changes for most customer-facing staff, which is important to know in advance. But if you plan it well, you can minimize that and make this something that really you can give your staff a lot of confidence about being able to implement and take full advantage of. And depending on which type of system you choose and how the scores are delivered, you can really maximize your ability to interpret credit scores and turn them into reliable loan decisions. Technical tools to deliver scores in real time, which could be through computers, tablets, or mobile phones, are fairly critical for maximizing the cost savings from credit scoring. We'll go into that in a little more detail later. And perhaps most importantly, consistency of processes across an entire institution is critical for maximizing the benefits of credit scoring. You need to start from a strong baseline. Your processes should already be consistent, and customer information in your database should be as complete as possible. Data best practices should be followed, and again, those are in the appendix and are based, some of them may seem very basic, but those are based on troubles that we have encountered with client institutions in various countries in East Africa and South Asia, and are, I think, fairly helpful suggestions for getting started with any sort of system like this. And credit scoring is really going to be more difficult to implement and less effective if these institutional improvements are not made first. So it's important to not jump into something like this until you're ready for it. In terms of timelines and costs, there are a number of different types of credit scoring models that you can implement. There are universal models that are sort of off the rack, such as those offered by companies like Experian and TransUnion or sold by government credit bureaus. And they can be used immediately when you sign up, but because they involve delivering scores that are abstract numbers, like a 750, for example, in-house tools to interpret those scores must be built. And accumulating the institutional knowledge of how to plug these in with your other information in your underwriting process and make a reliable calculation tool that produces great credit decisions does usually require more than one full loan cycle and occasionally multiple years. So it is a longer-term process, even if you can get the scores immediately, to learn how to interpret them in a very systematic manner. Then there are custom models. So first access algorithms, for example, are customized to each institution, and they allow banks to automate their credit decisioning. So they deliver specific loan terms, and we'll get into what that looks like later. And that creates, as a result, cost savings immediately upon implementation. But the timelining for having a custom algorithm built, because it involves a really rigorous analysis of your past and current portfolio data, is 2 to 6 months. So it's a collaborative process. It involves interviewing various staff and making sure we really understand your effective risk appetite, your unique clientele, your goals, your cost structure, etc. So again, that process involves an algorithm being built for a longer period at the beginning, and then, but when it's implemented, you start realizing those cost savings immediately, particularly in terms of reducing the evaluation costs. And of course, credit loss savings come over time with any sort of credit decisioning, any sort of credit scoring service. And then there are scorecards. So some banks will either build internally or hire independent consultants to build credit scorecards. These are sort of basic rubrics for how to underwrite based on very obvious risk factors that have been identified as a result of the bank's experience, but the consultants are often not from developed, they are often from developed economies and aren't as familiar with the dynamics of informal markets, and so they would bring perhaps experience from building FICO models in the United States or other types of models in a developed economy that are not necessarily going to be as relevant in a developing economy. And they also do not accumulate the network effect of expertise from building models for many loan products and many banks across many countries, or come with any technology for delivering those scores. So, and then perhaps most important, their models are often largely theoretical rather than empirical, meaning they're never going to be as accurate. And they're static, meaning they grow even less accurate over time. And so you really want, if you're going to have someone build a credit scorecard, which is not as strong an option in my opinion through my experience for First Access, if you do want to hire someone to do that, it's important to make sure that you have a way of having it updated over time according to how well it's performing, and that you decide on a technology for how that information is going to be delivered to your staff in real time. Costs for these different kinds of models generally range from $50,000 to $500,000, but it depends on bank size, customization, technology, integration with your MIS, and a number of other factors. So a little bit of context, and then just to be very explicit about the goals so we're all on the same page. Credit scoring allows us to better predict loan performance of potential customers, and sometimes existing customers who are applying for new loans, then to segment them and offer more cost-effective loan terms or streamlined evaluation process, customer acquisition process to each group. Adjusting those loan terms for each segment is known as risk-adjusted pricing. And the scarcity of reliable customer data and the labor cost of collecting it have really prevented risk-adjusted pricing from being widely adopted in developing countries. But through the First Access methodology and some other innovations that are happening, and the increasing use of mobile phones and access to these quote-unquote alternative data sources, there's now a lot more innovation in how you can not only create credit scores, but make them more accurate and use them more effectively and really maximize your cost savings. So how do we measure success? Great risk management is all about reducing risk at the extremes. In the case of credit scoring, that's going to be the very low-risk borrowers and the very high-risk borrowers. The goal is really to separate them from those who are average or who are more difficult to predict. And those who are more difficult to predict, or whose performance is more difficult to predict, they're kind of this middle group. They may make up 30 to 60% of all new customers at the beginning, and will need to undergo your standard evaluation procedure. So we're not talking about a radical change in your business model or the job function of loan officers who are normally interacting with potential customers and existing customers. But as you accumulate more data and experience, you should be able to accurately predict risk level for more of your customers and shrink down that middle group so that you're able to automate more decisions for high-risk people, more decisions for low-risk people, and then have your loan officers dedicating their time to a group that is decreasing in size as you get better at predicting this. So I just want to go into the numbers behind credit scoring for a moment. And before we do that, we are going to do a poll question. If you can please give us a sense of whether your organization is already using credit scoring in its underwriting process, just yes or no.
Great. And so we've gone ahead and opened the poll. This is a pretty easy one to answer. And so we'd like to hear from each of you. We're going to take about 30 more seconds here to find out whether or not your institution is already using credit scoring. And so we'll take another 15 seconds here. And thanks to everybody who's been voting. And we will go ahead and close the poll. And about 45% of the participants are currently using credit scoring, which is great, and about 55% are not. And I would suspect, Nicole, that the reason why they're on this is because they're planning to or thinking about it. So as you're moving forward, just consider that even if they're not using credit scoring currently, it's in their plan to do so.
Okay, great. So a credit score is kind of a broad term, actually, and it can consist of multiple components and may be offered in the form of a FICO-style number on a large scale. So somebody may be scored as a 610, or a grade. They could be a BB or some other letter, or any other indicator of a relative point on a scale. Since credit scoring models and algorithms can be structured in so many ways, it's often impossible to compare their accuracy between companies or institutions that offer them. So learn the metrics and make sure that you compare apples to apples. There are a few metrics for accuracy here that are examples. Some people will say our model is a certain percentage accurate, and this is often such a high percentage that it may be 99% or 98%. But be careful of any institution that claims a percentage accuracy, because it's a very kind of nebulous term. Sorry, I'm having some technical difficulties here. So any institution that says that their scores are a percentage accurate, you should really dig a bit deeper and see if you can get one of the measures below this and compare that across other companies or institutions. So sometimes people will talk about the first decile capture. This is the volume of defaults or the percentage of defaulters identified in the lowest 10% of scores. The higher this number, the better, but it will very rarely be 100% just because we usually don't have enough information to have that level of certainty with something like credit scoring, almost regardless of what country it's being done in and how sort of data-rich an environment that is. Another metric for accuracy that people talk about is area under curve. This would usually be 0 point something or a percentage number. And this showcases how well a model identifies borrowers as good or bad, which is really more of a statistical term, but is referring to whether people are going to perform perfectly or less than perfectly. And 0.5 for an area under curve metric is purely random, so it's the same as flipping a coin, while 1.0 would be a perfect model and is impossible, or incredibly rare and has never been possible at credit scoring, at least. Another metric that people use is the Gini coefficient. This would also look like a number between 0 and 1, usually as a decimal. It's very similar to area under curve, but because it's from 0 to 1, there's a wider range rather than being between 0.5 and 1. And then finally, the best metric really is how much you're going to save per score, or the impact of a score on your profit margins or return on assets or other metrics like that. This value can differ from one client to the next, but if you look at it as an average across a portfolio, this is objectively the best metric because it makes a direct link between credit scoring accuracy and your bottom line. So if you are considering credit scoring from different sources, it's really important to push for the most detailed accuracy metrics you can get rather than just taking at face value some claim of 96% accurate, 98% accurate, because there are too many different ways to measure percentage accuracy, and so it's just something to be careful of when you're considering where to get your credit scores. So let's go into customer segmentation a bit, which is kind of the first step once you've got access to credit scores that you need to take advantage of, is how are you going to use those scores to segment customers. So this is a chart of a distribution of risk across a customer base. You can imagine among all the people who are applying for loans at a given institution, this is the number of customers on the vertical axis, and then the risk level from low to high on the horizontal axis. So there's usually a reasonable portion of customers who are excellent credit risks and relatively easy to identify using credit scoring. And then the bulk of customers, as I was saying earlier, are going to fall somewhere in the middle, where their exact performance and loan terms are more difficult to predict than extremes on either side. And then there's a relatively smaller group of customers who are very high risk and can be identified from the get-go as well. So what does this look like when you get into segmentation? So you should identify places where you're going to draw a line or threshold and automate decisions about the loan applicants for anyone who's above that line or anyone who's below that line. And you need to do this at the high-risk end and at the low-risk end. Sometimes where you could draw these lines can feel arbitrary when you're looking at risk across your entire portfolio and kind of line up everyone according to how risky they are or have been, but it shouldn't be arbitrary. A good credit scoring company can help you identify where to place those lines and give you a strong justification for where they should go. Automating approvals and rejections is one of the fastest ways to realize cost savings. But unfortunately, instant decisions cannot always be correct. Even so, provided that you choose these thresholds correctly, your cost savings will more than justify the choice to automate. So there may be a few exceptions in the group that you automate, but by and large, your cost savings should be so significant that they should outweigh those exceptions. This is just, again, because we don't have perfect information. So 100% certainty, unfortunately, does not exist. And what this would look like in practice is, let's say you'd automate this low-risk customer segment or bucket or group, and there would be a few people who would not perform perfectly in that. You could draw that threshold even closer to the end. You can make that customer segment even more narrow. And when you do that, you get a higher degree of sort of purity or consistency among those customers. However, it's usually worth it to, over time, as you gain confidence in your credit scoring system, move that threshold a bit toward the middle, because you should be getting better and better at predicting customer risk and saving money as a result. So you should begin with 2 to 5 segments, no more, no less. More tends to be way too complicated, and obviously 1 segment is really no segmentation at all. So if you're going to do 2 segments, you could do 1 group that you're fast tracking and 1 group that undergoes your current evaluation procedure. You could potentially draw many thresholds and adjust the loan terms for each segment. The pros for this are that it is more cost-effective pricing. The cons are the practicality of implementation and the fact that this just gets to be really confusing among the staff if you have 10 different customer segments and they need to understand exactly what types of loan terms they are encouraged to offer to each segment. That can be very difficult to manage and for everyone to keep track of. So we usually recommend 3 at the beginning or 5 for an institution that is starting from a really, really strong baseline and has a staff that has a basic understanding of credit scoring already. There's always going to be a middle group of people whose performance is harder to predict, as I was saying. These customers really need the strong evaluation protocols that you've already established. So as you can see in that middle section, the group is much more mixed, and it's harder to predict, drawing any kind of vertical line, how people are going to perform. And so you've got just a few people who don't perform well in the lowest risk segment. It's very mixed in the middle. And then you've got a few who might have performed well in the highest risk segment, but your cost savings from skipping the full evaluation process at the 2 ends are much greater than any increase in arrears among the low risk group. And in general, in terms of how financial ecosystems evolve in any given country, once a country has a reliable national ID system and an inclusive credit bureau with data from all sorts of credit tools and credit lines that are out there in the country, and an institution has a well-honed credit scoring model, these decisions will need more careful attention than the outliers. And I'm referring to the customers in the middle will need more careful attention than the outliers, because you're just not going to have as much information about them. And many of you excel at this already, and that's how you've gotten to be where you are now. And so the goal is to keep your staff and your loan officers really focused on their current evaluation procedures for this segment of customers that are less clear. Sorry, I'm not sure what's going on, but my slides are advancing without me. So let's do another poll quickly. If you're using credit scoring already, is it an internally built system that your bank created, or are you purchasing scores from an external company or government entity. You could just say internal or external.
Great. So we've opened up the poll again, and so this is for the institutions that are already using credit scoring. Let us know if it's something that you built internally or if you worked with another entity. And I'd be really curious, and I'm sure Nicole would be as well, if you worked with a different company or government entity, please feel free to share that within the chat box as well. So we're going to take another 10 seconds or so here to finish the poll. And we're really seeing overwhelmingly results for internally built. So that's interesting. And so for that 20% that didn't, that had another company or government entity, please feel free to share that, and we can come back to that as well. So we'll go ahead and close the poll, and 82% are using an internally built system, and 18% are using an external, either another company or government entity.
Great. Very helpful. So now let's go into options for risk-adjusted pricing and what you can do once you have decided how you're going to segment your customers. So the most difficult part of credit scoring in the developing world, in our experience, is turning an abstract risk level, like a 750, into a loan decision. Part of the reason behind that is that there's no one-to-one relationship between an abstract credit score and a loan size. So if someone's credit score is 750 for a loan of $2,000, is it still a 750 for a loan of $20,000, for example? And it's important to understand that there are three main characteristics of a loan that usually contribute most to its risk level, aside from any factors related to the customer himself or herself. So just the loan characteristics, there's tenor, size, and interest rate. And for a loan applicant of a given risk level, any two of these could be predicted given the third, or you can predict one given the other two, which is even more reliable. So in the credit scoring that we do, sometimes there are institutions that want to keep interest rates static and vary tenor a little bit. Let's say they'll do 6, 9, or 12-month loans, and then mostly they want to vary size. And so the scores that we would deliver in that case, because they are customized, would account for that institution's risk appetite and their choices about risk and where they want to draw those lines for the customer segmentation. And we would be recommending a specific loan size given that tenor and interest rate, or those few tenor options and a fixed interest rate. But you could also be varying interest rate or tenor more. And so, for example, what happens a lot is if a central bank caps one of these, what you can do is make size and or tenor much more dynamic based on risk level. So knowing that these are the three levers that we can pull, let's look at an example of risk buckets and how we might price according to risk. So let's say we've decided loan size and tenor, and we want to vary interest according to risk. So these are vertical buckets. This curve is the number of customers. You've got a smaller number of people at the low risk end, a smaller number of people at the high risk end, and then the bulk of customers in the middle. So the first bucket would get just a basic interest rate, R. The next bucket, the medium risk, would get R plus some kind of additional risk premium, and then the highest rate bucket, the highest risk bucket, would get a slightly higher risk premium, and then all the way on the right would not qualify, for example. So that base rate is going to need to be decided by the bank based on its cost of funds, its operational costs, and the market-driven price for both lenders and borrowers. When we're working with client banks, we usually help establish and adjust these risk premium increments as we go, and it's something that is really important to understand in terms of how you are going to implement and to be reviewing on a regular basis as you are testing your credit scores particularly over the first and second loan cycles, to make sure that you've got risk premiums and that you're pricing this in a way that makes a lot of sense for your bottom line and how well you are able to segment each group. So let's do another poll quickly. If you buy credit scores from a credit bureau or other company, how do you systematically turn them into loan decisions? It's kind of an open-ended question, but for those of you in the 18%, you want to give us a little more detail on how you turn something that is more abstract into a credit decision at your institution.
Great. So this is a very open-ended, so we're looking for some responses into the chat box. So I know it was a very small percentage of you that are working with an external company. So if you could give us a little bit more information about how you're turning this this into loan decisions, that would be great. So we're just looking for some responses, and go ahead and type your answer into the chat box, and we'll wait a few more seconds here, another 15 seconds. So we'll wait a couple more seconds here. And we're not getting a large response on this poll, but it looks like some folks are using, combining it with the data that they already have at their institution. And also looks like through the judgment of a loan officer. So it looks like some of it is more objective and some of it is more subjective.
Okay. Interesting. Well, we may add one additional poll question on at the end if we have time, or get into it in the discussion. Let's keep going. So strategy and implementation for credit scoring. So you've got a couple of options for those of you who are considering implementing credit scoring, which I believe it was about 45%. You can use credit scoring services offered by someone else and the software that comes along with it, or you can build your own. There are a lot of benefits of custom models because they take into account your institution's risk appetite, the unique characteristics of your clientele, and your particular cost structure, which can vary a surprising amount between institutions. You always want dynamic models. You really need to be careful of creating one static scorecard and using it over a long period of time without ever reviewing it to see how well it's working for you and adjusting it accordingly. And if you're using credit scoring services that are external, you also get a huge network effect of that company having built models and been doing credit scoring for a wide variety of loan products, because they understand much more intricately not only which risk factors and characteristics and behaviors among consumers can determine risk, but also how those characteristics may interact with one another, which is much harder to pick up on through anecdotal experience, and really something that we can take much more advantage of now because we have much better data mining techniques and data mining software out there that can help pick up patterns that would be difficult for people to detect in real life. But regardless of whether you're using external credit scoring services and software, you build your own, there are a few strategic questions that are really important to remember before you implement. So one of them is, should you introduce new loan products when you begin credit scoring? And in general, we strongly recommend not to, because whenever you're making changes, it's hard to isolate the impact of those changes unless that's the only change you're making. So if you implement credit scoring and you release new loan products, particularly one that's directly tied to the credit scoring, before you've really gained some experience scoring your existing loan products, it can be very hard to not only manage in terms of staff responsibilities and keeping everyone clear on what's going on with that loan product, but it's much harder to evaluate how well the credit scoring is working. And so we really recommend usually to wait at least 6 months before you introduce some new loan products, and just to score as many people as you can who are coming into your portfolio during that time, so you've got a strong sense of how those scores are working before you start a new loan product, because you really will, that will inform, or it should inform, the design of any new loan product. And you really, it would be nearly impossible to sort of guess in advance exactly how that loan product should be structured if it has a direct relationship with a credit score, for example. So if you let's say your credit score gives you a probability of default, and you say we want to start a new loan product that's capped at a certain level for anybody who's under 4% probability of default. But if you really haven't been using the credit scoring yet, it's just, in practice, it's very, very difficult to know how that loan product should be structured until you've been credit scoring for a while. So we usually recommend waiting a bit. And also, before you start, lay out a growth strategy before you implement a new model. So are you trying to reduce defaults? And if so, to what level? What's your goal? Are you willing to grow more slowly to achieve this? And by how much? How much more slowly do you want to grow to achieve that level of defaults? Or alternatively, are you trying to grow faster, and by how much? And are you willing to do so at the cost of a potential uptick in risk, and how much? And I think it's really important to lay those things out in advance, because if your credit scoring tool that you're implementing is well designed, you should be able to adjust these levers as you go if you are very clear on what the goal is. And I think it's important to review among the senior management and with boards and investors, if necessary, what the specific goal is and what their risk appetite is, because there are trade-offs between credit losses and expenses. And so you could automate instant approvals for a very large segment on the lower risk end, and there would be exceptions to that, and you would have an uptick in losses, but generally that's still going to be much smaller than your total cost savings from not having to do a full evaluation of that group, because the evaluation is usually the most significant cost in the customer acquisition process. And so there are these short-term trade-offs between being inclusive and lending to these uncertain customers early on, because that improves your credit scoring model at a faster rate, and that allows a deeper presence in any given geography. So it means maybe you're not trying to lend to just the cream of the cream, but wherever you've set up a branch, you're willing to lend to a larger number of people, not only to have that outstanding portfolio and keep growing in that particular geography, but also to improve your model. Whereas focusing on more certain lower risk borrowers may achieve impeccable performance but require operating across a greater geography. So if you only want to focus on very, very, very low risk borrowers, that may increase your transaction costs because you have to be dispersed across a wider geography as you're growing. So those are just some high-level considerations. Another thing that I'm not going into much in this presentation, but that I should mention, is if you're building a credit scoring model internally, or if you've got a relatively small portfolio in terms of the number of customers now and you're trying to grow quickly using credit scoring, another really important consideration is just that you don't want to have perfect performance in those early loan cycles, because you need a mix of people who perform well and who don't, so that you can identify what those riskier customers look like. And so at the beginning, when we're working with clients that actually want to be able to grow very, very quickly using credit scoring and are starting from a smaller number of customers, they don't have much data on people who don't perform well, which means that it's going to be harder to identify those people. And so actually we recommend that in the first couple of loan cycles you have a higher than normal percentage of defaults, meaning that you're going to lend to people who you think are higher risk, to test and make sure that your assumptions about that are correct. So you want to be able to identify the people who are high risk, which means you can't avoid them at the beginning. And so, let's go to the next slide. So we're going to do one more poll. Are you interested in credit scoring to manage a small portion of high-risk loan applicants, or more fundamentally revolutionizing your efficiency across the whole portfolio? You could just respond few high risk or portfolio efficiency.
Great. And so we're going to do this one very, very quickly. So we'll only take about 20 more seconds here. So if you're looking at using credit scoring more for risk management of more high-risk portfolio or efficiency across the entire portfolio, please go ahead and answer now. And we'll take a few more seconds here, just about 5 more seconds. Great, and we'll go ahead and close the poll. And a pretty high percentage, 84%, are looking to revolutionize efficiency across the whole portfolio, whereas about 16% are looking at addressing those challenges with that smaller, high-risk portfolio.
Great. So this is an ambitious group. I like it. What we've seen in practice is that for institutions that are focused on that smaller group at first, once they have been able to address that, they often then want to move into credit scoring for the entire portfolio and really trying to radically improve that efficiency. So let's think about how segmentation improves efficiency and competitiveness for an institution. So if you've got an original borrower population that is, you don't know anything about them yet, and then you credit score them, you can often segment them. So this is an example where we segmented by percentage a 5-segment portfolio. So very low risk, sort of discretionary, average, or unclear, and then high risk or very high risk. And so what we recommended in this case was to reject the very high risk group because it was quite clear that they could not afford credit and that it was going to potentially get them into cycles of over-indebtedness. We automated instant dispersal of the very low risk group, which as you can see was a big proportion of the total. There was another group that after a visit from loan officers, so that lighter green, the gray, and the lighter red, those people all got an in-person visit from a loan officer who went through the standard evaluation procedure, and then that green group was identified to be low risk once we had that additional information, which in many cases was more tied to collateral than anything else, although there can be a few other important factors that matter when you're visiting in person. And then the gray group was a bit more medium risk and discretionary from our perspective because it depends a bit on the motivation of the organization. Are they trying to be more inclusive and grow the accuracy of their model as quickly as possible, or are they trying to just focus on really great performance? And then the lighter red or sort of pink group was a bit high risk and was still lent to in some cases, but with adjusted loan terms to compensate for that. And all the time saved from the dark green and darker red groups enabled the institution to take on a pretty significant number of new customers who are represented in blue. And those also turned into a spectrum of risk levels, but you could potentially take all those cost savings from not doing the in-person evaluation of people you're certain about at the moment that they apply for the loan, and you could use that to disperse only to people, to new customers, to additional customers, to the blue group who are very, very low risk, for example. So there are a lot of ways that you can tailor this to your exact goals. So the software built by First Access enables institutions to adjust their risk preferences anytime and gives them these choices of segmenting their customers and offering risk-adjusted pricing in terms of interest rates, sizes, or tenors, depending on their preferences, and then targeting very low-risk customers to maintain high repayment standards, as well as incorporating new data sources to identify new customers with specific risk profiles. And that particularly includes mobile phone usage data. We're working on international relationships with most of the world's major mobile network operators, and right now we are using mobile phone data in Tanzania and have found a lot of important indicators that help automate these credit decisions at the point of sale or the original point of application for a loan product, so that a loan officer does not necessarily need to visit someone in person. So it kind of expands the size of that very high risk and that very low risk group. So who should score customers? There are a lot of different ways that you could there are a lot of different people or sort of points of contact in the customer acquisition process who could be responsible for actually getting a score. And we do meet a lot of institutions that are having a score created or purchased at the time of the credit committee. But one thing to keep in mind is that once the credit committee comes around, once a loan application gets to the credit committee, you've already spent all of the time and thus money to evaluate that person. and you're not really realizing any cost savings from the credit score. And so it really just becomes an additional tool to help identify what the loan terms should be. But it's so late in the process that it's not saving you as much. It might bring down your credit losses a bit, but it's not going to reduce the amount that you spend on an evaluation because you've already done it. So what we recommend, and the way our software works as a result, is that the credit score happen at the time of the loan application before anything else happens, because we can identify, so as you see moving from these yellow gears, which represent first access software, we can create an initial decision to fast track a borrower to approval or rejection if their risk level is very clear, or to collect further information through a loan officer visit. And so, as you can see, and as we've discussed, you can kind of segment out these high-risk and low-risk groups according to whatever threshold you want to choose, and then spend your loan officer's time, and thus all of your resources, just allocated much more effectively toward customers who really need that further evaluation. And just as an example, in East Africa, we've seen approximately, I believe in Tanzania, about 38% of loan applicants are so low risk that the whole relationship with them that an institution maintains once they are customers could actually be very, very low touch, and that they don't necessarily need an in-person evaluation. They don't need that more time-consuming and often subjective evaluation in person at their homes and their businesses. And so it's important to decide in advance, do you want to try to reduce your operating expenses in addition to credit losses, and if so, credit score people as soon as you can. As soon as you can get the information that you need from them to create your credit score, which should be based on how past customers have performed and their characteristics and behaviors and cash flows and other information that actually correlate with risk level in the past. As soon as you can get that information on a new customer, create your credit score and act accordingly. So delivering scores and decisions, this is a bit more specific to First Access, and since so many of you are using internal credit scoring models, I'd be interested to hear during the discussion period how you are delivering that information to your staff or how you are having them retrieve it. So we have user-friendly tools for managers and staff. We've got a web dashboard. We've got we can integrate with all sorts of tablet applications that are being used for underwriting, and we have an SMS gateway as well. So people can retrieve real-time scores from the web or any mobile device, even if they're not in the branch. And these tools, we've got interactive tools to help them interpret the scores and credit reports. We can do automated performance reporting and notifications for managers and staff. So if someone's risk level increases, for example, we can have a red flag notification sent to the loan officer responsible for that person, which is much easier with mobile phone data than any other source of information. But if their behavioral patterns change, it's important to know that, so we can kind of ping the person who's responsible for that relationship and tell them to check in on that customer. We can also do MIS integration through application programming interfaces, and so that's much easier for cloud-based MIS systems, but there are exceptions where we can do that. And real-time decisioning that's going out to loan officers via SMS. So a loan officer can meet a loan applicant anywhere in the field. And there's a demo on our website, firstaccessmarket.com, showing how this would work. But the loan decision that would come back to a loan officer looks a bit like this. It would say the recommended loan size for this loan applicant is X amount of Tanzanian shillings, immediate dispersal approved. And so while First Access is measuring that person's very objective risk level, that information is then being put together with this bank's risk appetite and their preferences to create this loan decision. So it's really the senior management delivering their decisions in real time to their staff. And the loan officers often don't need, at the point of sale, any sort of complex report about this person. They really need the one conclusive piece of information that allows them to act. So in this case, a loan officer would go ahead and approve the loan, and the person could go straight to signing their contract and to the cashier, or a mobile money disbursement if possible. or the person could be instantly rejected, or the loan officer would find that the person needs further evaluation, in which case they would go through that standard procedure that we've discussed that all of you have already implemented. So just to go through our methodology, which is fairly unique in the field, but I think you'll see some of it's collaborative. We do all of the heavy lifting, and it's a good example of what you can do when you really want to take full advantage of the data that you have internally, sometimes bring in external data sources, and then you want to implement a credit scoring system that really maximizes your profitability. So we do a free data consultation, which is a collaborative process to learn what information you're collecting and should be collecting. Then we customize metrics, particularly creating definitions of performance that you would consider good or bad based on what your goals are. So how do you want to define default? How do you want to define arrears? Are you using any sort of grace period, etc.? Then we measure your entire past portfolio and its performance using those metrics and those sort of yardsticks or meter sticks. And then we examine real patterns among the risk factors in your portfolio and determine what your effective risk appetite is. So who have you been lending to? What is the maximum sort of risk level that you've been lending to in your existing and past portfolio? What terms have you given them? How does that vary by risk size and practice? And we build a predictive dynamic algorithm based on that. So it's entirely based on empirical patterns in your past portfolio and the market, and in some cases involves bringing in external data sources like information on outstanding debt from a credit reference bureau, or mobile phone usage data, or utilities, or mobile money platform data, any of those things, which can be very helpful. And then we do what's called back testing, where we would test the accuracy of that algorithm once it exists against historical loans. And there's this concept of in sample and out of sample, which is a statistical term and is not super easy to understand, but what it means is that you build an algorithm based on part of the past portfolio, and then you test it on anyone who's outside that past portfolio. So you take all your past borrowers and you segment out, let's say, 30% of them, and you build an algorithm based on the real patterns that you see among those 30% in terms of how they actually perform. And then once you've got that algorithm, you would run all the other 70% of loan applications through it, pretending that you don't know how they actually perform. So you set up a blind test. So you're going to put their performance information in another file. You run them through your scorecard, or in our case, your algorithm, and you test how good is that algorithm based on the 30% at predicting for the other 70%. And the reason, and so that's out of sample. That 30% is in sample and the 70% is out of sample. And the reason you can't test algorithm accuracy in sample, or any statistical model accuracy in sample, is that you won't get accurate results, because those loans, that 30%, is kind of endogenous to the model. It went into the model building process, and so you won't know how well your model works until you actually test it out of sample. So that's what we do, and we can discuss if needed, and then we simulate future scenarios to understand the most probable results. And so then we implement the credit scoring, which is collaborative, and track and improve with machine learning techniques. So I'm going to skip over, we're getting right toward the end, I'm going to skip over this, but it just looks at some different indicators that we can include in credit scoring at first access and that are often included in credit scoring, including mobile phone data. And then there's a bit more detail on how the credit scoring works through the first access methodology. And then we can do a lot of mapping to track progress and set up notifications. And this is an example of a case study of how good our segmentation is for one particular institution, and I believe this was in Kenya. So we identified 4 segments, and what's important here is that you've got these 4 customer segments from high risk to low risk, and what's important to know is just how much in arrears as a percentage of each of these segments, how much of the portfolio actually went into arrears. And so what you want to see in any segmentation study is that a very small percentage of yellow, in this case, it exists in a very low risk bucket, and that percentage gets higher as you move toward the higher risk buckets. So this is what happened as a result of that increase in profit margins and decrease in credit losses, and you all will be able to download this presentation and you can look through the case study in more detail later. There's a bit more detail on first access achievements, which you can look through at your leisure. And just to touch quickly, in the appendix, it goes through data best practices. And that is, again, what we've learned is important for institutions to collect and for them to organize their data. So make sure that you take a look at that and that you are generally following these. And I'm happy to answer any questions about them at any time. We're sort of booked out for deployments of new models through mid-April, but if you're interested, this tells you where to sign up for first access. And let's move right into questions.
Nicole, thank you so much, and we've got quite a few questions coming in, but peer learning is a big part of Capital Plus Exchange and what we like to do, and so we have a couple of our partners who are going to share a little bit about their experience using credit scoring and how they implemented it. And so we have Anthony. I've just unmuted you. If you could share, if you want to tell us which institution you're from and share a little bit about how your institution has implemented it and any successes or challenges in using credit scoring. Anthony, are you there? Can you hear us? So we may be having some technical issues with Anthony. I'm not sure if you're able to hear us. And we have another partner. Ranga, I'm going to unmute you. Ranga, can you hear me okay?
Yes, I can hear you clearly.
Great. If you want to share which institution you're from and your a very short story about how implementing credit scoring has been working for your institution, any successes and any challenges.
Okay, our institution is called FBC Bank in Zimbabwe, and whenever we do loan processing, the whole process of verifying applications and going through applications, we always use credit scoring to determine the status of the individual in terms of their credit history, mainly the borders of Zimbabwe, and also their rating in terms of the variables that would affect their in the salaries at the end, where they come from, their age, and everything else.
Great. And are you using an internally built program, or are you using an external credit scoring?
It's an external credit scoring.
Okay, great. And how long has your company been using credit scoring?
I joined the company about 1.5 years ago, and ever since I joined them, they've always been using it.
Okay.
So I'm not sure how long they've been using it, but ever since I joined them, they've been using it.
Great. And was it you don't know necessarily about the implementation, but is it fairly easy to come up, and have you had good successes in terms of repayment rates and in terms of lowering risk?
I should say yes. Mainly in terms of risk in particular. Repayment rates you can calculate using other forms of calculations, but mainly on the risk factor, it's pretty useful.
Great. Well, thanks so much for sharing. I'm going to put you back on mute. Anthony, are you able to share a little bit about your experience? I'm not sure if your microphone has worked. Okay, looks like Anthony's not able to share at this time, but Nicole, we do have quite a few other questions coming in, and I think some of the questions have to do with what's sort of the role of collateral and guarantors. Does that change once you're using a credit scoring? Do you have to use less of these other features because you have better risk, telling what the risk is of a loan, or how are those pieces affected?
That's a great question. Unfortunately, the answer is it depends. It depends on how strong your credit scoring tools are, and potentially also on the kinds of loan terms that you're offering. What we've seen, so we actually incorporate guarantor information and even more so collateral information into our credit scoring for institutions that use it. So what would happen is those people at the far ends, very high risk and very low risk, would be approved or rejected instantly. And for everyone who needs further information in general, that further information would include collateral, and we have the institutions, the loan officers usually send us that collateral value, for example, after that in-person evaluation, at which point we would create a new loan decision that incorporates it. And so what we've found is collateral assessment usually does make a loan lower risk, but we also work with a lot of institutions that do unsecuritized lending, or even that collect information on sort of an estimate of assets rather than using something officially as collateral for a loan. And so I would not say that credit scoring necessarily replaces the use of collateral, but if you wanted to move into unsecuritized lending, you certainly want a strong credit scoring system to be able to do that. And in some cases, yes, it could make up for that information not being available. And one other quick thing to say on the use of collateral is what we found is that it does impact the loan's risk level, but not even when you look at the lifetime of that collateral and whether it gets seized and auctioned off in the case of a default. We've actually found that the loan officer's initial assessment of collateral, even irrespective of whether that collateral is ever seized, that initial assessment is predictive as well. So it increases your ability to predict how someone will perform. And so, which is a great thing because it's good for consumers. So, other questions?
Great. Yeah, we have a couple questions in terms of when you're actually putting together and implementing your credit scoring. So how do you go about building a data set to influence your model actually before you go live? And also in terms of products that you're using, you know, if you're implementing credit scoring, how does that affect any loan products? Do you need to change or adjust the features of your loan products so they fit in better with the credit scoring?
Sure. So I'll actually answer that second question first. I would say your credit scoring should be adjusted to your loan products rather than needing to adjust your loan products to your credit scoring. It's better to find a way to score the same loan products that you have been using, because the more data you have on that accumulated experience, on that number of customers, the better your credit scoring will be. And certainly before you want to change any loan products or offer any new ones based on credit scoring, you want to make sure you have a very high number of scores on your existing portfolio. And we usually recommend a minimum of 2,000 credit scores or past borrowers in your portfolio whose data is incorporated into a credit scoring model before you would actually change any loan products in any dramatic way or start a new loan product, start offering a new loan product. And in terms of how to go about creating this model, I mean, what you need to do is make sure that you have as complete information as possible about all your past customers and how they performed on their loans and exactly what the terms of those loans were, which may seem obvious, but in some cases is widely dispersed and in branches and things like that, not always centralized. So make sure you have all that information at your fingertips, and then you need someone who has experience not just in banking, but specifically with statistical modeling, because they're going to know the rules of thumb. They're going to know the things that go wrong in real life when you're implementing something that was too theoretical. So you need somebody with great statistical experience, and ideally in credit scoring and ideally in developing countries, but sometimes institutions choose to go with people who they want to build a very basic scorecard rather than a real algorithm that's based on those past borrowers in a lot more detail. So what happens then, you get all your information together, you get somebody who knows what they're doing, and you have them build a model that is predictive of past performance using a portion of the portfolio. And then, and there are a number of different statistical models that can be used for this. Logistic regressions are kind of the most basic one. We use a lot of data mining techniques which help you identify patterns that would not be visible to the human eye, really, because they're too complex. And that has been wildly successful. We found all sorts of things that we did not expect to see, but we've now found across countries, across loan products, across banks. So you take your statistical model, you build it on a portion of the portfolio, and then you test all of the other people in your past portfolio with the information you had when they applied for a loan. And then you compare those predictions to how they actually performed. And so that out-of-sample concept is very important, because otherwise you won't know how your model is going to work in real life. And so then once you've been able to test that, you should see how accurate your model is. You can rebuild it, you can tweak it, and see how its accuracy changes. And then you can start actually scoring new loan applicants in real time.
Nicole, how many years are you typically looking at in terms of the past year portfolio and in terms of the number of years data that you need?
We actually look at as much data as we can, whatever is available. So that sometimes goes back 10 years. Usually at a certain point, if you go back far enough, even if an institution was actually lending, it didn't necessarily digitize those records. And so I would say on average we're getting 3 to 4 years of portfolio data, but in some cases it goes back further depending on the age of the institution and when they started recording everything in computers. I would say the minimum that you need is at least 3 loan cycles worth of information, and on over 2,000 people.
Great. Very, very helpful. You know, in terms of actually using the scoring and how it's used at your institutions, are there any institutions that are using the financing decisions just based solely on credit scoring? And how does scoring change, you know, if a borrower has missed a payment? Is the scoring for that client updated, or is it really just more at the loan origination stage? Nicole, are you still there?
Yeah, I'm here. Sorry, does anybody want to answer that, or would you like me to discuss the implications of those?
No, go ahead. You can go ahead and.
So we usually find it most practical to change someone's score at the time that they apply for a loan, unless there is a live integration with a bank's MIS system, in which case, as that person's performance is going down, so if they start missing payments, then we can update their score automatically. But usually that score wouldn't be updated or sort of recreated until and unless that person reapplies for another loan afterwards. But in models where we are basing credit scores in part on mobile phone usage, for example, then you can see that someone's behavior is changing over time, not just from the bank's perspective, or possibly not at all from the bank's perspective, but that it is changing in other ways that we can track through their mobile phone behaviors. And so in those cases, we could update scores in real time as well. But in general, there's only sort of a need to update a score when somebody is applying for a loan.
That's great. That helps a lot. So there's a couple more questions in terms of first access experience. Have you worked with any digital instant loans like the Shwari? Do you work with microfinance institutions? So maybe you can share a little bit more about some of the clientele that that First Access is working with.
Sure. So most of our, I would say a slight majority of our clients are microfinance institutions, and then most of the rest are commercial banks, though there are some exceptions. We're doing some testing with companies that do loans for solar lamps, for example, that are really distributors of solar lamps, not giving loans for any other purpose, but want to offer financing for that, financing for other assets, supply chain finance, etc. We do work in some cases with companies that are using digital transactions like mobile money payments, and so if you're evaluating a small business that is, let's say, an airtime vendor who's doing a really high volume of selling of airtime scratch cards, those top-up cards, if that's their primary business, the bulk of their transactions would actually be digital, and so you can incorporate those cash flows really easily into a very reliable credit score for them that can be very accurate. But in general, I would say we're working with lending institutions that are doing sort of longer-term loans, not as many. We've got one that does 30-day loans right now, but many of them are doing loans that are between 6 and 18 months and on fairly standard microfinance terms, both securitized and not. And they are, let's see, I was going to add one more detail. I think there was one other component of your question, Jessica, that I didn't answer, but now I can't remember what it was.
I think you covered most of it. I actually think you know, quite a few people have questions about developing the data set and, you know, how it fits into the other pieces that they're using, the collateral, the cash flow and guarantors. Sure. So I'd like to encourage everyone, if you have questions, please feel free to contact David or myself, and we're happy to put you in touch with Nicole. And then we'll also take 1 or 2 questions on our LinkedIn page after the fact. So if we unfortunately didn't get to your question today, please continue to join this conversation on our LinkedIn page. And so we'd like to thank everyone for sticking around, and we went a little bit over today, but thank you so much for joining us, and thank you so much to Nicole for leading this excellent session today.
Thank you, everyone. Thank you, Allison, David, SBDN, SME Finance Forum. That's great. And if anyone has any questions, I'm happy to answer them directly on the LinkedIn page, etc.
Perfect. Thanks so much, everyone, and have a great rest of your day.